Hello. Well, welcome back. My name is Olaf Jones from Insurance Europe, and I intend to give you a bit of an overview about the impact of Solvency II on institutional investment. And I was asked to answer the question of whether it helps or hinders institutional investment. So I'll try to do that through these slides, and in particular highlight some of the concerns we've had in the course of the development of Solvency II. But also talk about some of the improvements we've seen and through the CMU and the CMU and Capital Markets Union Plan and the Juncker Plan. So very briefly, Insurance Europe represents the insurance industry in Europe. We're a federation of federations, so organizations such as the ABI in the UK are one of our members, in fact I think one of our largest members. But I think the key point in terms of this discussion is the fact that the insurance industry in Europe is by quite some way the largest institutional investor. We have nearly 10 trillion of assets under management, and that's covering life, non-life, reinsurance, mutuals, and in some, depending on the country, sometimes quite significantly the pension industry in that country as well. And every year we get 1.2 trillion of premiums to invest. So the rules that and the market environment can make a huge difference as to how and where we invest, and therefore we're very interested in, obviously, and affected by regulation such as Solvency II. Now I think it's worth mentioning just in terms of Solvency II. I mean, this has been a huge project. It's taken 15 years to develop. It is still not quite implemented. Many of you will know that 1st of January 2016, which is not very far away at all, will be the date where we finally implement it. And I think the industry has actually been very supportive of this project from the beginning. The key objectives that we had way back when we started were about ensuring very high levels of policyholder protection, transparency, high standards of risk management, harmonized regulations across Europe, and a strong and efficient European industry. And collectively, the industry, but obviously together with other stakeholders, in particular the Commission, EIOPA, and the local supervisors, have spent an enormous amount of effort on this project. Now, getting the design right is really crucial to achieve the objectives and to avoid unintended consequences and costs. And we'll talk about some of those during the course of this presentation. And I think that we've made some progress in dealing with some of those concerns, but with a project as large and complicated as this, I think it's not surprising that not all of those concerns were dealt with. Fortunately, there are many review processes built into Solvency II where we can make further improvements, and we'll touch on those towards the end of the presentation. So, a long journey from 2000 roughly to 2016, so a difficult path along the way. We had some delays. I think those delays had led to serious improvements under a process some of us are very familiar with called Omnibus II, which was a set of improvements to Solvency II, and I'll come and mention some of those during the presentation. But I think in the end it was worth waiting, but I do think in retrospect the project was overambitious, and maybe in retrospect we should have tried it in a series of improvements rather than a sort of a big bang approach, which was what we took on. So I think a very ambitious project which will have very ambitious results, but still some work to do. Now, in terms of the changes, not everyone will be familiar with Solvency I, but I think there was a general agreement that Solvency I was no longer fit for purpose. It's a very simplistic regime. It wasn't keeping up to date with how companies wanted to manage and how companies felt it was right to manage in terms of capital. It had very little other than some simple capital requirements. It was based on a cost accounting valuation approach with very limited rules over the assumptions for liabilities. Of course, Solvency II changes that fundamentally with a market valuation of assets and a best estimate of liabilities. I won't go through all the changes, but I think this presentation is in your notes, but I think it's really important to note that this is a huge sort of revolution rather than an evolution of regulation covering every aspect. And many of you who are familiar with banking will know that it's also based on a three-pillar approach, so that the solvency rules are just one part. And very importantly, there is a very large section, Pillar 2, which is about risk management and governance standards and how we need to interact with our regulator, supervisors, and also a very strong and important pillar 3, which is about our reporting to the supervisor and external reporting. And to just give you a sense of how much change, as I note on the slides, Solvency I, with 14 different directives which related to Solvency I, had 199 pages describing everything. Solvency II has well in excess of 3,000 pages. Also, in terms of reporting, Solvency I had very few reporting requirements, and they varied quite a bit by country. Solvency II, I've put there, actually, that's a bit out of date. EIOPA has, fortunately, sort of simplified the reporting structure, so we have something like 150 reporting templates, but the actual data sets haven't changed. They've just reorganized them into a more efficient structure. So very significant changes. In terms of institutional investment, one of the good things should be whereas in the past every country tended to have strict limits on certain investments, normally most of these, if not all of these, should be replaced with a risk-based approach on which Solvency II is based. So those limitations, restrictions should go, although I have to say there are signs that may not go in every country, and some may stay, and some new ones may be put on, but I'll mention that a bit later. But I think the biggest issue we've had is the treatment of long-term investment, and that obviously is core to our involvement as institutional investors, because I think while not all insurers are long-term investors, a large majority are, and if you look at our asset base of that 10 trillion of assets, I think roughly about 75% of that is related to long-term investment and about 25 to shorter-term non-life and shorter-term products. And I think the key problem we've had is that for us, the long-term nature and the predictable nature of our liabilities means that we are able to hold assets long-term. And in the case of bonds, that may be to maturity. But I think the key point is we have control over when or if we sell. And that is incredibly important to our business model. That also means, from a risk point of view, we can avoid losses on forced sales in many, if not all cases. And that means, in turn, that we can avoid or reduce the short-term exposure to short-term market price volatility. Now, unfortunately, one of the founding principles of Solvency II means that it has taken the view that insurers should be treated like traders, as if everything we're doing is trading and we have to be able to close off our positions and sell our positions down at any moment in time, and certainly based on the quarterly reporting or annual reporting. And that means that it assumes we're exposed to prices in the same way as traders. And basically that's just not the reality risk-wise, and that then leads to some problems with the measurement system that we'll talk about. I mean, I should stress that for many of us in the industry, this is actually a relatively small part of Solvency II, and almost all the rest of Solvency II, while we may complain about a bit of sort of excess of reporting, excess of bureaucracy and documentation and things, in general, almost all the rest of Solvency II, there's strong agreement that makes a lot of sense. I think this is the one element where there is a big disagreement with something which is a fairly fundamental principle. But if you look at how much would have to change in terms of text, it's a relatively small changes you'd have to make to fix this problem. And to some extent, there's been some progress already that we can build on. Now, the reason why this matters so much is it makes such a big difference to how you measure risk. If you take a trading approach or if you take a long-term approach, it matters for many asset classes, and in particular infrastructure, as we'll see. If you, for example, look at the impact on how we measure credit risk for bonds, if you take the trading view, you look at a mark-to-market price change, and during the crisis, because spreads ballooned incredibly for a relatively short period for some assets, but still they did balloon, and so you could see for a very long-term, even high-quality AA bond, you saw very large changes in pricing, if you're talking about a 15, 20, or even longer bond. However, if you look at the actual default rate during that period, or actual loss rate, because that's what we should be looking at is a loss rate, it's very low. Now, that period may not have been the worst case 1 in 200 sort of target that Solvency II really wants every company at a minimum to be able to withstand, but I think we don't think it's anywhere near 30%. And that's simply because you're looking at the problem from two angles. Is the insurance company exposed to the actual price movement and a forced sale, or is it exposed to the defaults and recovery aspects of the bond? And I think this is something that we think deserves more debate. And in many more cases, we should take the view, in many cases, it's actually the default and recovery. So that's one example. Another one is the debate we've had about securitizations. It's the same debate. If we look at what the actual accumulative default rate was, and this is a 5-year default rate during the crisis period for, if we take what is now generally called a high-quality securitization of the type that was more typical in Europe than say, America. If we take a 5-year one, because a lot of the figures in Solvency II are quoted as 1-year figures, so they don't really give you the sense of how much capital you'd actually have to hold. So I'm looking at a 5-year securitization. The actual defaults of those sort of assets were about 14 basis points accumulative over about a 5-year period during the crisis. The original calibration under Solvency II, under the quantitative impact study back in 2009, 2010, was actually 80% of the asset. Now, that was because they looked at the global set of securitizations, including American ones, including all the CDS squareds, everything, and they looked at the price change and said, well, during the middle of the crisis, this assets dropped in value incredibly. So if we're going to take an extreme view, a 1 in 200 view, you've got to use an 80% capital charge. Now then, EIOPA were asked by the Commission, please look at this again because you'll kill the asset class, and we need this asset class, and insurers would like to be able to invest in this. EIOPA then created very cleverly and very good, I think, this idea that actually there are different securitizations. There were some which you could classify as high quality and some not so high quality. And if they could define the high quality one, they could use a different calibration. That was a very good move, and I think EIOPA one of the first to develop that idea. And in doing so, they could look at the spread change in both. And they said, well, if I look at the spread change in the higher quality ones, it's a bit less. We come up with a 42% capital charge because they're very volatile, but less so than the general portfolio. Again, unfortunately, 42% will have still killed the asset class, and it certainly, in my view, is completely out of line with the risks insurers face when they invest in this sort of asset. The Commission used EMIR and other developments and other improvements in the general world and risk management of securitizations to lower that to 15%. Again, if we compare it to the actual defaults or the banking approach, which looks at defaults, and that's even before they look at high-quality securitizations, again, we see a very different picture. So again, for me, this is not about do we do a risk-based approach or not? Do we throw out a risk-based? Do we make a political decision just to slash capital, just to help investment? No, this is about asking the question, what are the real risks and have we captured them? And then finally, I thought it was worthwhile sharing with you some initial analysis we're doing, but I would say this is quite early, and I really am looking for the academic community to do much more of this and to challenge this and to have discussions about what is the real long-term risk in equity investment, especially when invested through products like insurers can and have done in the past. I sort of looked at what's the difference between taking a 1-year approach, which Solvency II currently does, a 10-year approach and a 10-year smoothed approach. Just looking at, in the US market, which is the most data, what way can your perception of the actual measurement of risk change? And what's interesting, when you take a 1-year approach, of course, you get to the Solvency II type calibrations of a 1 in 200 loss of about 43%. Solvency II calibrates that at 39%, so very similar. If you take a 10-year view, it's much lower, partly because of dividends. If you accumulate dividends, you automatically get offset against the value risk, as well as, in some cases, the actual worst case the worst case change in value can also be lower. But of course, you get the biggest change when you move to a smooth approach, which is all it's doing. The same we do in non-life. We take someone who has an accident and someone who doesn't have an accident, and you put them all together, and you create an average. Here we're taking people who made a great, huge gain because they invested just after a crash, with those who were unfortunate enough to invest just before a crash. You average them out, and the outcome is not necessarily so bad. In the case of the American market, you actually never would have had a single loss in a rolling 10-year smooth period for the last 100 years. So that doesn't mean there's no risk in the market, but again, the question is the risk 50% or thereabouts, or is it something less? And I think, again, when you take a long-term view, the way we invest, the flexibility we have of whether we buy and sell and what we do, I think changes the nature of the risk in a way that deserves much more thought. So I think that's the background of why this sort of measurement issue is so important, and it's something that hasn't been thought about enough, partly because most of the research is all about a trading approach. Very little has been looked at how does it change if you take a long-term view. And also I should mention that, of course, we can't ignore the issues of surrender risk, and of course in discussing all this you have to take into account to what extent can the insurer's liabilities really be long-term, can that change? So this needs to be part of the discussion. But I thought I'd just also, in time trying to explain the issue to you, is also make sure that it was understood that in Solvency II, this issue of measurement manifests itself in two ways. First, because solvency ratios are a function of available capital divided by required capital, it means the measurement issue can affect both of those, and therefore create maybe greater problems than is often perceived. Because we measure at the moment all assets based on a market value, irrespective of whether they have a value. So even infrastructure, for example, we are currently required to work out a theoretical price based on the projected returns discounted by the implied credit rating. So if it's rated, it gets BBB or AA, etc. If it's not rated, we're meant to use the unrated category, which is equivalent in many cases to a BBB, assumed to be a BBB. But that means that you're using a volatile spread to value something which has no market price and create a notional market price. So even in the case of infrastructure, we have a sort of volatility problem in terms of the valuation. And because infrastructure is so long, 15, 20, even 25 years, changes in spreads can have an enormous change in the market value. And therefore, that will flow through to the balance sheet, which flows through to the available capital directly, because those same volatilities will not manifest themselves in any significant way in the liabilities. So our net value, and therefore our available capital, as measured by Solvency II, can be very volatile for long-term assets like infrastructure. And then on the bottom side, required capital, as I said, because that is measured based on a notional change in value, again infrastructure, unlike the presentation we saw before, talked about infrastructure being lower default, better recovery. Basically, up to recently, that's been ignored, and they just looked at the theoretical change in price that could occur in terms of the worst case change. And the calibrations were based on that, not based on any default or recovery approach. And again, that can lead to an exaggeration of the risk and therefore problems. So basically, just to give you a sense of how big a problem this volatility, because most of the people talk about required capital, because in banking, for example, in the banking book, it's based on cost accounting, so there's no volatility. In most other regimes around the world, it's not based on a volatile asset base, so you don't have the same problem. But to give you an idea of how much problem it would have caused, if you look at the Solvency II, before we had these improvements over the last few years, we've had a number of improvements in terms of trying to avoid volatility, and I'll talk a bit about them in a moment. But basically, if we didn't have those, and we just measured the assets in one way and the liabilities separately, the spread changes would just have an absolutely enormous effect. In this example, I show a company, different companies, a 5-year company, a company with 5-year liabilities, with 10-year liabilities and 15-year liabilities, and just shown what impact the spread changes will have on net capital and therefore your solvency ratio over the last 10 years or so. And you can see this notional company would start off with a very healthy 200% capital ratio, but for the longest term liabilities and therefore the longest term assets, that would have changed briefly to negative 200%. And that's even with a relatively high quality I think this is a AA asset basis. So you can imagine if it's BBB, it's even worse. Now, we have had some improvements in terms of something called a matching adjustment and volatility adjustment. The matching adjustment would really help this, but almost no one qualifies for it. The volatility adjustment, we don't think would help this very much, and we're in the process of trying to analyze that. And that's something we're going to be discussing with the Commission to see to what extent do the measures they've introduced really help this, or is it there's still things to be done? And we believe there's going to be still things to be refined. Now, of course, I'm exaggerating the problem by taking one particular business. In reality, an insurance company has a whole range of businesses, so this problem is embedded as a sub-part of a total portfolio. But what it does do is, if it's not fixed in the next few years, companies will move away from this business model, because on a product-by-product basis, from a strategic and return on capital point of view, these products just won't make sense. So while we can manage for a while, because they have, as I said, a whole range of other products, and this is part of a much bigger picture, if this is not improved, companies will move away from their traditional business model, and we don't think that's good overall. So that's just to explain how the combined impact of the effects come in. I'll just discuss that a bit later when I come to infrastructure. But I think, as I said, this matters obviously for the insurance industry, but it also matters to policyholders, because otherwise there's a risk that we invest in much lower risk assets than we actually need to. And that means their pensions, your pensions, over the next 10 or 20, 30 years could be much lower, or we won't be able to offer any guarantees. And then we'll be pushing all the risk onto the individual. And as I said, we think that if we do pooled investments with appropriate, transparent, and well-designed long-term smoothing mechanisms, we can actually offer guarantees and smooth returns in an efficient way, in line with our traditional business model, and they can be designed to be fit for purpose in the new world where you need transparency, you need good governance, you need all of those good things. And that's one of the things we want to avoid being forced to move away from, only because of a measurement issue and not because these products are fundamentally flawed. It also matters for financial stability, because one of the advantages of the insurance industry with our 10 trillion of assets, during a crisis when the market is maybe acting in a generally assumed irrational way, and if you look back in history, the spread changes have never been followed by equivalent defaults. Even if you go back to 1929, 1970s, 1990s, you see ballooning of spreads for very logical reasons, lack of liquidity. Most people don't have the luxury of having long-term illiquid liabilities like we do. So the pension funds, the insurance industry, the wealth funds, sovereign wealth funds, we can all step back and look at the value and say, we will sell assets which we think are basically not worth much anymore, but if we think this is a market temporary issue, we can hold, we can wait, and that creates stability. That creates anti-cyclical behavior instead of pro-cyclical behavior. If we all are forced to pro-cyclical behavior, including the insurers and pension funds and everyone, the market crises that we've seen may be just made even worse. And what's more, when the prices get really low, if our analysis indicates that this is a market sort of issue rather than a fundamental issue, we can start buying. And we've seen that in the past. Insurers, especially I think the most famous case in the UK was in the 1970s, where the insurers went back in the market and really helped the recovery, because asset prices got so low that was a good move for the policyholders, and of course it helped restabilize the market. So I think that this is an important issue, not just for insurers, and it's linked to our ability to invest, of course, in infrastructure. Again, this slide just indicates, of course, how big we are in many markets in terms of assets, across all types of assets, of course. Infrastructure, ironically, is a relatively small part of our investment book. It's currently only less than 1% is our estimate. But of course, if we increase that by 1%, you're talking about 100 billion more investment. So just in going from 1 to 2% could make a lot of difference. So then just to talk a little about infrastructure. One of the problems was that Solvency II didn't look at infrastructure in any specific ways, and therefore it was treated just like everything else. Unlisted equity was charged like hedge funds or private equity, and debt was charged like other corporate debt. So the EC asked EIOPA to look into this, and also the Parliament is also very keen for this issue to be addressed. And now, as you probably know, that there's in early October the Commission issued a new delegated act, which is one of the legislations that controls Solvency II, and have indeed improved the calibrations. Now, we strongly proposed that they should at least consider a default approach instead of a spread approach. I think for the time being that's still considered a little bit too radical, a bit difficult to fit in at short notice, but we believe this deserves further thought, and I think fits in with all the conversations you're having now about the attributes and the risk characteristics of infrastructure. And instead they used the economic differences between infrastructure and corporates to justify lowering the calibrations, the spread calibrations. So I must say the outcome is reasonable in the sense that it leads to, we think, calibrations which better reflect the risks, but some of the logic is still, in my mind, not quite right. So I'll just go straight on to here. So basically, in terms of outcomes, some of you may be aware of this, but as a result now, a 25-year BBB infrastructure loan or debt would move from 33% capital charge down to 22%, and equity, infrastructure equity, which was 49%, will reduce to 30%. So we call this very good steps in the right direction. We very much are glad that the issue is being discussed, and there's a recognition that some of the calibrations could be wrong, but I think it's unfortunately just a step, because this will not solve the issue. These are still calibrations, in my view, far in excess of the true risks, and in addition, it doesn't solve the valuation issue. These are still valued in a very volatile way, and that can create a big need for a capital buffer, which will continue to make these assets less attractive for insurers than potentially they really are on an economic basis. I won't go through that, but I think that you can see there we've shown you the difference in calibrations that actually have occurred for the different categories. Also, just for interest, I've given you the current bank ones. Again, it's very difficult to compare different regimes. I wouldn't necessarily say you can compare the bank calibrations easily to the insurance, but I think it's worth noting that, again, the banks currently take a default recovery approach in their calibrations, different from insurers. I do think it's ironic that insurers are for some reason treated like traders, and banking books are given what I would say a more logical treatment. So again, I think this is something we need to discuss going forward. So how can these concerns be addressed? Basically, ahead of the finalization of Solvency II, we had a whole range of issues that need to be addressed. The infrastructure was one of them. Long-term assets was a big one, probably the biggest. But there was various other ones on the treatment of currency and lots of sort of, one could say, smaller issues, but that could have quite a big effect for particular markets and particular products. We accepted that not everything could be fixed before Solvency II was launched. We didn't want Solvency II to be further delayed, so we accepted that we'd have to fix this afterwards. And in recognition of that as well, Solvency II was created with quite a few review processes, recognizing that with something so big and complicated, you can't get it right first time. So we're relying on those processes to generate further improvements, and we'll be engaging with the Commission, and the Commission has indicated interest. And in fact, we can see from the recent call for evidence from Commissioner Hill as part of his Capital Markets Union plan. He is asking the question, is there anything else we need to do? Please give us the evidence, please explain. So we will build on that process, and as I said, we have had some improvements, but not quite enough. So I think we've covered those points about the fact that the Juncker plan is a positive step, but not quite enough. I think one thing I will mention here is that I'm focusing here on one of the three planks of the Juncker plan. The Juncker plan had a pipeline, which was a part of the project, which was about significantly increasing the number of projects. It had a second part, which is about the Strategic Fund for Investment, the FC, the 315 billion fund, and then the final one was the removal of barriers. I would say that for insurers, we have another fundamental problem as well as these barriers, which is there's just not enough suitable infrastructure assets. So we really need a significant improvement in the availability and accessibility to infrastructure assets overall, and that, together with removing the barriers, will allow us to invest as appropriate for our policyholders, but there is a big appetite potentially out there. So there's the call for advice, which is good. There is another process which is due to be finished by 2018, although the Commissioner said it could happen before, or parts of it could happen before. And then there are other regular review processes that we can make use of. So in summary, is it a help or a hindrance to institutional investment? I think, first of all, moving towards a risk-based prudential regime definitely should help insurers, because it should remove local restrictions to investment. It should also encourage and allow companies to align risk management and capital requirements with good practice and good ALM and get lower capital where the risks are lower. And I think Solvency II has definitely led to significant improvements in risk management, in governance, in data quality, in modelling, in a whole range of things that have been triggered by it already, and that's a good. However, its current bias towards a short-term trading approach will be a hindrance and needs to be addressed further through the review processes. Thank you. I think I've run over on a little bit, but I think maybe give a chance for one or two questions.
Thank you. During a while, the main difficulty for improving the lot of infrastructure was finding a definition for infrastructure everyone could agree on. Has it been reached now? Do we have a definition?
Yes, we do have a definition, and I think there I would say there is, in one respect, there's one big problem with it, which is the exclusion of corporate structures. But apart from that, I think we are generally satisfied with the definition. As I said, the one thing it does is leave out corporates. To give you an example, Heathrow, the Heathrow extension project is structured as a corporate, would not qualify. But the Commission has recognised this and has asked EIOPA to look again to see how certain types of corporates that basically are focused around pure infrastructure investments can be included as well. So we're hopeful that will lead to that improvement.
And does that mean, for example, the water companies in the UK would be infrastructure, would not be infrastructure?
Sorry?
Water companies in the UK, for example.
No, I think basically corporations that undertake activities which could be considered as infrastructure, such as building companies, water companies, those would not qualify. So general corporates do not. If a water company wanted to create a project which was focused on improving a drainage system, and they separated that into a separate project and sought funding for that, it's possible that could qualify. But not as part of they can't just raise general debt, which is in part going for infrastructure and partly funding other activities. It has to be a specific project linked to the financing. Yeah.
Thank you. I just want to pick up on an area of interest to me and that Mike Wilkins raised briefly in his talk earlier on, and that's in relation to sort of previous wisdom was that capital markets investors originally were looking at a kind of A rating category for infrastructure, and then the various initiatives were designed around that. Really, then there's been a hunt for yield and a chase down the credit curve such that people are investing in BBB- transactions now. It seems to me with the capital charges that we sort of briefly saw there that whilst they may be getting more yield, absolute yield, return on capital for insurance investors, it makes much more sense to be higher up the credit curve back to the sort of A rating. Could you sort of comment on how you see that sort of panning out in the new Solvency II world for insurers?
No, you're exactly right. And one of the problems we have is explaining to, especially in some cases, this is perceived as a customer protection. There's a perception that any changes in capital must be terrible for our policyholders because we're putting them at risk. What is not always realized, exactly what you say, is that the higher the capital, basically our required yield on those assets goes up. So we can still invest, but it becomes a sort of, again, a risk-return issue. And if the yields aren't out there, which often they're not, we just therefore step away from investing. But I think that right now it is just, companies do want the yield. So some of them, if they have enough spare capital, they may still say, well, okay, I've got spare capital. It's more than I think is economically needed But I've got enough capital to hold it. So I will still go for that yield, because overall my business model requires it and it's the right thing to do. So I think it depends. Those companies which are more capital constrained will be much more sensitive to the issue, and others will be less sensitive. But I think over time, everyone's going to be looking at things in a very disciplined capital way, and that's why we've got some time to fix this problem. But if we don't fix it over the next few years, companies will get much stricter in that risk return, including the actual allocated capital, and I think it will push them away from these assets more and more. But I think for the time being, while there's excess capital, some people will say, I'll invest anyway.
Thank you.
Thank you. Just one question. I guess if an insurance company that wants to invest in infrastructure has two options. You can either do it direct, set up your own team, buy the actual asset, or give a mandate to an infrastructure fund. Under a Solvency II point of view, is the treatment exactly the same, or are there any differences?
No, it should be exactly the same. There's a look-through principle, which basically says if you're investing yourself or via a fund, you should look through at the underlying assets, and it's the underlying assets that will drive everything in terms of risk and governance and capital. There is one extra element of that which the Commission has done to try to help smaller companies get access to this, and they've created a fund structure called the LTIFs, which is a bit different from UCITS. UCITS are really designed for liquid assets. LTIFs have been designed for illiquid assets such as infrastructure. And the hope or expectation is that companies, fund management companies, can create LTIFs, maybe a 10-year LTIF, a 15, a 20-year LTIF, and then smaller insurance companies can use that for their ALM and get access to these assets. The problem, as I said, is right now there is not enough assets to invest in. So we have to solve both problems, the availability of assets and the capital treatment. I think then I've overrun enough, so I'll probably close there, but I'll be around a bit later in case anyone has any questions. Thank you.